Well, hi, everybody. My name is Chris Weston. I'm head of research here at Pepperstone. I'm really excited about the live trading event that we've put together today, and through the whole series as well. We're tapped into some of the brightest traders for you guys to learn not just the process that got them to where they are at the moment and how they get their edge in trading, but also, how they refined their process over the years. And hopefully you guys can learn from some of that as well. We're going to be looking at some of the charts as well and looking how we're going to play some trades, hopefully play some trades along the way and look at some key setups. But we're going to tap into their minds so that you guys can learn along the way as well. So it's going to be really exciting and some really good content coming through. So we're starting today with Blake Morrow. But before I go into Blake Morrow, I just want to read the disclaimer and go through the compliance situation to start with. So if you could just take a couple of moments just to have a quick look at this. And I think it's really important to understand that anything that I say today should be considered general in nature. It shouldn't be considered personal advice. It does not represent my employer, Pepperstone. It's really important to understand as well that if Blake does do some trades and suggest some trades that he's looking at, that these do not constitute personal advice. You need to look at your circumstances and do your own research around those as well. So with no further ado, let's introduce Mr. Blake Morrow. Blake, welcome to the program. You and I have known each other for a long period of time. We've interacted and we started interacting like a lot of this stuff through Twitter. We've done a lot of videos together, and obviously we've become quite accustomed to each other's trading styles. And it was really important for me to get you on as the first guest because our minds are so quite alike in that situation. You're thinking sort of fundamentals, technicals, and you're trying to marry it up to get a high probability outcome. But like what I also like about you is you have worked in the hedge fund industry. You've prop traded, you've prop traded markets. You now trade your own capital. You run ForexAnalytix with a group of other real gun traders as well. So you've got a whole sort of suite of perspectives that you can share with people. So why don't you just give us a little bit more, the audience, just a little bit more about who you are?
Well, first of all, thanks for having me, Chris. And it's always a pleasure working with you. I've enjoyed the years of actually partnering with yourself and with Pepperstone Securities, and you guys have been great to work with. Other than us being on the opposite sides of the world, which always makes time a little bit.
Well, you're in Arizona and I'm in Melbourne at the moment, so yeah, different sides of the world. But I feel together though. I feel together.
Yes, very much so. But one of the things you had asked me about, or you were saying about how I really got started or how I started trading. What's interesting is where we're at right now in 2021, at the time of this filming. It's very reminiscent of the time that I started trading in the late 90s. We're in the mid to late 90s where we were going through a dot-com boom. We're witnessing a lot of the same type of markets, if you will, going through cryptos. And I happen to be a beneficiary of that time. And I was fortunate enough to be trading through the whole dot-com, I want to say the whole dot-com era, because I really started trading not in the financial industry as a stockbroker, but started trading in 1996. And so I was lucky enough to have a lot of exposure into the dot-com companies. And it really gave me my kickstart into trading larger sums of money. And I spent many years from then on out being a partner at a brokerage firm at a small firm out of Dallas, Texas for a couple of years. Then we sold to the Wise Trade Group. Then I became the chief analyst there over the course of a decade. Then when MB Trading took them over. So I've kind of worked the whole gamut. And about 5 years ago, I was asked to join a firm out of Florida, which is co-owned with a firm out of New York, or excuse me, same partners, right? And so I basically had been a prop trader for the last 5 years. I traded for a group of wealthy individuals, and we were handpicked. It was just more of I joined this group of traders that have been together for many, many, many years. And it was a really very, very awesome experience, very eye-opening experience, and very much a departure from what I had been used to my whole life as a retail trader. And now just over the last few months, I've actually transitioned to just trading for myself and, focusing on ForexAnalytix. And it's interesting how my trading style has changed over the years, back and forth. So I can really say, Chris, I've been there, done that. But one of the things I haven't done, and I don't have the pedigree of working for a bank. And like my partners at ForexAnalytix, one of my partners, he was a interest rate derivatives bond trader for one of the biggest banks in the world for many years, and his style of trading is a little different than mine. But you learn a lot over those 20 some odd years of trading, and it's really shaped the way I do things today and how I find trades in the moment.
Yeah, that's right. Well, I think most of the stuff these guys do these days is managing flow anyway. So the prop traders stick to themselves in the hedge funds, and that's all been sort of siphoned off really. And the investment banks is all managing flow. Talk to me about. We want to go into the process and get and understand, how you come in and go for your decisions. But before we go into that process, the ForexAnalytix platform is really about your process, isn't it? I mean, you sort of go in there, you're looking through the different setups, you put it out to clients. Just because it is such an integral part to your process, just have a really brief, quick look through, the setups and how you shape your biases and on currency pairs using the ForexAnalytix platform there.
Sure, I'll do that, and let me just kind of show you. This is our baby that we created about 5 years ago, and I'll tell you one of the cool things about us is being partnered up with Pepperstone, and Pepperstone Securities has been a integral part of ForexAnalytix, especially sponsoring our live webinars that we do on a daily basis. But I want to show you like the insides of ForexAnalytix and what it does. A lot of people, I think, have they look at the screen and they have certain expectations, but really what this is different analysis from different styles of analysis. So everything from the M being macro analysis to C being candlestick, basic technical analysis, harmonic analysis, Elliott wave analysis. What we do is we try to combine multiple types of analysis so you can help better understand what direction a currency pair may be going. Like, for example, just if you notice the US dollar, Japanese yen, green being bullish and red being bearish, the candlestick, basic technical, and Elliott wave analysis is all pointing higher. And obviously, if you look at the U.S. dollar, Japanese yen, and what it's been doing for the last several weeks, it's just been moving higher consistently. And when you have,
I just want to interrupt.
Yep,
I want to come onto that dollar yen chart because the setup there is fantastic. Once we've done that, so I just want to once we've done the process, I think that dollar yen chart is going to be something that we can come to straight away. So I'll let you continue your process, but I just want to sort of just keep in mind that this setup right here, I think is absolutely fascinating, and I'd love to pick your brains once we've come through that. So yeah, let's keep going there.
Absolutely. And the thing about the analysis is not only do we have like the analysis, different types of analysis, but we keep for the week, the running analysis of from the start of the week all the way to the end of the week. So you can go back and see, what was their bias towards the beginning of the week and how's it evolved over the longer term.
Yeah.
And, we have, like I said, it's different types of analysis and matching up the probabilities to make a good trade. Whenever I trade, I have my process that I follow, but when I'm looking for conviction, I might look for one of my team's analysis on that specific instrument because I want to see what their take is. I understand that Elliott wave and harmonic analysis might be doing something counter trend pivot, counter trend. But if I'm trend trading, I understand that about the Elliott wave analysis. I might be completing a wave 3, or if it's a harmonic analysis, it might be a bearish butterfly reversal, but it's been trending higher. So knowing that about the types of analysis is also very important to what I do.
Well, I think that's fascinating. I think that's fascinating because I mean, I'm a similar situation where I'm blending various components in there, but this model that you're looking at combines a whole bunch of different variables, fundamentals, technicals, different types of technicals. And what are you looking for then? Are you looking for like a clean sweep of green to give you that really high probability, or a clean sweep of reds across those factors to give you that high conviction short? How's that marry up?
Well, that's a great question, and the short answer to that question is no, not necessarily. Because like I said, when I'm dealing with harmonic and Elliott wave analysis, I know those tend to be counter trend. So if I have like something that's trending higher, typically speaking, and then I see an Elliott wave analysis or harmonic analysis go the opposite direction, I might actually be more inclined to thinking that I'm going counter trend. But this is where, you take what we have in the platform, and then you have to marry it with what we do on a daily basis. One of the things that we do, and this is kind of the interesting thing about broadcasting at this time in the evening for me, it's a different time of the day for a lot of you that are listening in live, is that most of our broadcasts are happening during the European hours and the US hours. So it's since we're on the other side of the world, and that's just the time frames that our team is typically broadcasting, I might actually be looking at some analysis, but my intraday analysis might be slightly different than my longer term outlook. And that's important to realize, that when I do analysis, I'm thinking, okay, the dollar yen may be trending higher, but that doesn't necessarily equate to I'm only going to be long. And when we talk about process and looking for setups, one of the things I'm going to do with you guys today is I'm going to actually start with a clean slate of what we do. We call this the bias chart. This is a process that I have been following literally since the late 90s. When you could take me back to when I only traded equities back in the you could call it the .com heyday or technology heyday back then. I might only be trading semiconductor stocks. And if I was trading semiconductor stocks, I know there are certain stocks that are underperforming, and I know there's certain stocks that are outperforming. So I would say to myself, okay, if I'm going to be going long these semiconductor stocks today, which stocks are the best performers? Which ones do I really want to focus on? Or if I'm going to short the market, I'm going to short these internet stocks. Oh, Amazon.com was really underperforming, and so was broadcast.com. I want to short. I'm looking at those for shorts. Yeah. Even though the whole complex or industry group might be going one direction, I still will trade counter trend. But when you're trading counter trend, as long as you know you're trading counter trend, you can adjust your position sizing accordingly based on that. Yeah. I don't know if that made sense to you.
No, it does. I mean, I think there's really two ways to trade short term, and one is to buy strength and go with the momentum. The second one is mean reversion, and you just got to know when that point of maximum pain has been felt, because if you get it wrong, it can be quite painful. I just want to sort of just touch on what you've been doing there, because I've got a couple of questions. Gabriel Eichmann, hopefully we get to see some currency pairs are better to trade in short-term time frames. So looking at your model, keep the chart up, but in terms of your models, you're working, do you think in different time frames, or is it specifically high level sort of daily charts that give you that perspective, and maybe then you go into the price action to look at like 30-minute charts and lower time frames? How does your overall thought process work in terms of time frame there?
Well, that's a great question, and I'm always going to suggest that anybody, when you start trading, it's all about preparation. I would spend an hour on a daily basis, and I do actually more than that in the mornings with just the ForexAnalytix traders, going through the charts and finding out what that bias is. You'll notice that since I had the Aussie dollar up there, this is the analysis from earlier this morning. And basically I'm identifying that we are in a near-term bearish trend. And the reason why I say that is because, I'm looking at the daily charts, and I know that the Aussie dollar had broken down out of a triangle. And this is pretty much a head and shoulder pattern, but for all intents and purposes, it's breaking lower. But I knew that today.
Can you scroll in a bit more? Just take the time frame to take it in a bit more.
Okay, yeah. So this would be a daily chart. So I knew that my daily chart targets for the Aussie dollar really point two different directions. And by the way, this is my first target. This is my second target. You can see how I come up with triangle distance targets for the Aussie. So that means, over the course of the next few weeks, maybe even the next month, I'm looking for a low of maybe around 74 cents, maybe even as low as 72 cents. That doesn't necessarily mean that we're going to get there.
No.
And I can guarantee you it's not going to go down every day like today, or today in North America anyway. And so I look for bounces to sell into if I have a bearish bias, or if it's a bearish bias to me and I go, overall, we're going to be going down there, but I know that, we're going to get some mean reversion today because the dollar was weak. We had the Fed chairman. We knew he was all going to be weak. He paraded out some, Fed governors and their comments over the course of the last, couple of days to really temper down the bearishness that we saw in the S&P. We knew that was going to happen. So of course, we're going to get a bounce in the Aussie. We're going to get a bounce in risk. Stocks are near all-time highs in the US. So as that happens, we figured we'd see a bounce in the Aussie, a little bit mean reversion, but that also means that I'm looking to sell into strength because overall, I feel that the Aussie dollar is bearish in the
Just scroll right into that, because that's a really interesting pattern. This is one that we were looking. If you just go into there as just where we were, because we've had that move down. You can see we're off pretty grossly oversold conditions. If you want to constitute the RSI on that, but then we've had that short covering rally, which you say that you potentially look to sell into. But now we've got that price retesting the breakout zone. We've got price testing the 200-day moving average. Is this the time when you maybe take this down into, say, a 30-minute chart, 15-minute chart, look for that price to decline and then jump on board? Is this a high watch situation for you now?
And I'm glad you actually asked that question, because what I start with is the daily charts. And I really suggest that anybody who trades the markets, if you're going to trade the markets, even if you're just an intraday trader, you should always be looking at your longer term charts, then your daily charts, your weekly, your monthly charts, because you have to have a bigger picture of what it's doing. Like, I know for a fact, because I follow the Aussie dollar. It's very, very near and dear to my heart as far as what I like to trade, not because I'm, because I like you guys and everything at Pepperstone. but the Aussie dollar is one of my more favorite currency pairs to gauge risk appetite, what the commodities markets may or may not be doing, that type of thing. But the Aussie, I've known, has underperformed risk over the last several months. So if we have any move lower in risk appetite, meaning if stocks, after having this epic 95% rally off of the lows from last year, if we have even a 5% hiccup, the Aussie dollar is going to be the first one, in my opinion, that's taken out to the pasture and shot. I mean, it's going to be one of those commodity currencies that will drift lower in that type of environment. So as a result, I know that because I'm looking at the longer term charts. I see it diverging away from the S&P. I see it diverging away from even what copper's done over the last several months. Now I can drill into shorter time frames. So as you know what the longer term charts look like, I don't have to spend 10 hours a day looking at my daily chart. I glance at it once in the morning because I do it every day. I know it pretty much by heart. Then I can go into the 4-hour charts and the hourly charts and look for more precise entries. So this is when I start factoring in other types of analysis. For example, if I just take the move following the FOMC, the high of that move was right here on June 16th. So I can simply put in a high to a low. I know that we're already probing the 38% retracement, and that's where this number actually comes from earlier today. The 75.75. That actually came from knowing where we're at here at the 38% retracement. I know the 50% retracement's just under 76 cents, and then just above that is 76 and a quarter, is the 618, which is probably my more the golden fib that I'm going to pay closest amount of attention to. So I know that there are 3 levels of major resistance that the Aussie is going to be facing going into the next 24 hours in trade. Then on top of that, Chris, is I can go into, my ForexAnalytix charts and go, okay, well, Earlier today, posted on ForexAnalytix, there's a butterfly pattern that's setting up that looks at a 127% extension of X to D that comes in around 75.80. I know that coincides with my 38% retracement. And frankly, if we get up towards 75.80, I might be interested in a short to resume a downtrend in the Aussie dollar.
Okay, but price will be true, right? So I mean, you can give levels, and the whole point of having high watch levels is you're going to watch how price reacts. So, that's where you come in, you take your time frame down, you've got your key levels down. Let's say today we do get a bit of a push up, and I think it might take a little bit longer if you look at average true range and everything. It might take a little bit of time to get up there. But let's say we did get a move up there, and it's suddenly going on to Blake Morrow's radar. You're looking for price. If price was to decline and go down, you're interested in the trade. What do you do next? What's the next situation? Your first thing is. Yeah, how do you dictate your position size? Where are you going to put your stop loss? How much risk are you going to take on in that situation? How do you adjudicate those situations?
And that's another great question, Chris, because everybody wants to know, like, oh, well, what do I do? When do I get in? And really, that comes down to, for me, a lot of correlations. And it doesn't necessarily have to mean that, I'm shorting the Aussie because it's got a high correlation to gold. I might be looking at other FX pairs. I might be looking at how the dollar is reacting against the euro, or perhaps what cryptos are doing, or what risk appetite is doing in general, knowing that I'm not going to be selling the Aussie dollar if I see the S&P is rallying towards 4,300. So I do take in other markets to make sure that I'm not going to get run over, if that makes any sense to you.
Yeah, for sure. No one likes to get run over. I just want to go back to that dollar yen chart as well, because that's at a really key level. There's been a lot of talk on the floor. If we take the macro component of your ForexAnalytix platform, and I'm sort of speaking aloud, there's a lot of talk about tapering. We saw Mary Daly last night on the Fed. She's one of probably the most uber dovish, along with Neil Kashkari, talking about tapering by the end of the year. The market's sort of pricing that in. We're getting to this window of less liquidity, potentially higher real rates. That should really be good for a stronger US dollar environment. We're seeing dollar yen really responding to that, certainly after that more hawkish Fed meeting. If you can just scrolling into that chart a little bit more there, I'm interested to know I want to know what you want to do with this now, because we're getting a lot of interest from clients in dollar yen. What do you do with this chart now?
Well, so for me, again, I have to go back to the correlation part of it. And the one thing that I'm going to have to do with the dollar yen is say, as long as yields, like the 10-year yield, is moving higher, then I would be looking for a dollar yen to strengthen, or the dollar to strengthen against the yen, as long as the 10-year continues to move higher. And based on my analysis, of the 10-year, we are in a bull flag pattern.
Right.
And so we currently, as long as we don't breach last week's lows, it looks structurally bullish for yield. So that means that the US dollar, Japanese yen should continue higher. Now, what I have to do, and what I left this open for you guys, is if you go out to the weekly charts, and let me go ahead and zoom this out a little bit. One of the things about the dollar yen that, this is why you have to go into your longer term charts, is because the dollar yen is also probing what I consider a pretty big weekly trend line off of some highs that comes in basically where we're at. And so this is a make it or break it week.
Yeah,
Yeah, it is. And look, it's Wednesday, and a lot can happen. Is it Wednesday?
Tuesday. You're getting ahead of yourself.
Wait, it's Tuesday for me. It's Wednesday for you, right? So, but being that we're halfway through the week, I know, and and everybody at home knows that a lot of things can happen by the end of the week. So, I'm very cognizant that the dollar yen is in breakout territory, and it could indeed break out and move higher. But I also don't want to get caught in a situation where, you break out to new highs, and then I kind of forget that I'm in that trade. And then, next thing you know, it reverses pretty hard on me. And then I got a false breakout, and I got to deal with that. Because false breakouts and false breakdowns are, in my opinion, some of the more powerful reversal patterns that you're going to find in the marketplace.
Absolutely right. Yeah.
Whenever you catch the market, wrong-footed, whether they were long, everybody's like, it's a big breakout, I'm going long. And then, you saw even today, for those people that are watching, Bitcoin probe below 30,000. I think everybody was like, well, here we go. We're going to go from 30,000 to 20,000 pretty quick. And then we've reversed and Bitcoin rallied, a couple thousand points, caught everybody wrong-footed there, bearish. That happens in currencies all the time. And that's the one thing that I have to keep in mind, especially as we're approaching, multi-year highs and what I consider trend highs, above this 111 level. Yeah, I mean, we're getting there, and I think we could reach above 111, and if we can hold it, that's pretty bullish. But again, we still have a couple of days left in the week. So, and not to mention just that, Chris, I know this is a live event, so we're talking, a lot of what's happening right now at this moment. If you look at these other yen pairs, like I'm just showing you the euro yen, for example, and I should have taken this off before I started talking to you guys. We broke a pretty big trend line this last week, and we're just challenging the underside of that trend line. And when I see this weakness in the rest of the yen pairs, not the dollar yen, which tends to be the driver, but you have the euro yen, the guppy or the pound yen, that's the sterling yen that's trading up against the 618 retracement, the Aussie yen, which is, holding horizontal support, but I could argue barely. The Kiwi yen right up against the underside of them. Now this is a didn't mean to do that. This is a multi-year trend line, or a post-COVID low trend line, broken. We're testing the underside of it. So whenever you start pushing up against the breakdown points, and you're dealing with a currency pair like the dollar yen, which is strongly correlated to the rest of the yen complex, I'm going to be extra careful about trying to play that dollar yen to the upside if I see all these other yen pairs that are struggling, right?
Yeah. I just want to quickly jump in, because you're obviously working pretty closely with patterns and generally the structure and feel of the ebb and flow of the market. But we've got a question from Robbo Wolf. Shouldn't we focus on how many buys and sells in the market? Now, obviously, we can't do that in an OTC market, because you just don't get to see the same that sort of buys and sells like you do in an exchange like the S&P, for example. But I think what we can do is extrapolate from that question. You are obviously a very technical trader. You've got some fundamentals in there as well. But how much do you look at basic, just naked charts, price action, just solid candlestick analysis, and looking at the aggregation of flow through pure price action?
A lot. And let me first of all, and I think that's a great question. And I have to mention alongside with when you trade currencies is a lot of flow, and I think it is a lot of positioning. So, do I take in CFTC data when I'm, looking at knowing that, long exposure in the euro is pretty high right now, or short dollars. I take that into consideration. I look at the daily sentiment index and take in those DSI numbers every day. And, all of that helps me formulate my plan and how I want to attack the market. But yeah, if you're going to be trading shares, or you're going to be trading, in the US, we might call them equities. If you're just trading independent, individual equities, you might be more focused volume-based trader. I do focus a lot on candlesticks, and especially on a daily basis. One of the and I'm going to plug him here really quick, but Chris, Brent Donnelly, right?
Yeah. Yep.
From HSBC. Him and I, we talk privately from time to time, and he's probably one of the more respected trader, economist, analysts out there in the FX space. Yeah. And he loves, catching people wrong-footed, and so do I. And that's the one thing that a candlestick chart will tell me more than anything, especially if you start looking at a 4-hour or a daily chart. When you see good reversal candles, that basically just suggests that the market was caught off guard at some point that day or that 4-hour time interval, whatever the case may be. And that, to me, speaks volumes about positioning in the market.
Well, let's go to the Bitcoin chart then, if you've got that up, because yeah, we've seen that trading at the bottom end of the range. I know that you've put out a few charts recently on Bitcoin, but you can see that big candle that's come down through those lows, and I think that this probably, it talks about your point there. Case in point, we've had a trade through the lows. The market's tried to close below there. It's failed. The buyers have come in. There's been a big rejection of that former spike low. If you're based on pure price action, and we've seen that higher high coming in, I mean, do you want to be long Bitcoin here on the back of that, or do you think there's just going to be people looking to sell into these rallies here?
First of all, that you trying to trap me right now? You're trying to trap me in a Bitcoin call?
I'm not. I know you've been.
I know you
bearish.
are.
I know you're quite bearish on Bitcoin, like a few other people, but it's got to wait for that. It's got to wait for the close through the bear bear flag for to get down to those sort of 15,000, 12,000 levels, right? But what does that candle mean to you?
So, well, first and foremost, it's interesting that you bring this up. I've been a Bitcoin bear, because ever since we've been below the 200-day moving average, ever since we broke through this support. Anybody who listens to me on a daily basis, here's my analysis right here. And every day for the last 2 months, Bitcoin has been designated as bearish. And I'm like, hey, while we're below the 200-day moving average, any move back up to above 40K, you got to look to be a short, because we're building a bear flag pattern. A couple guys have noticed this, very ugly head and shoulder pattern. Whatever it is, it's telling us that it's relatively weak. So I tweeted about it last night, a little over 24 hours ago. And when I got up this morning, it had been retweeted and I had a bunch of followers. So I'm assuming Zero Hedge, which every once in a while Zero Hedge like retweets me, and then I get like 1,000 followers that just pile on for whatever reason.
What do they call you? They call you a finfluencer or something like that.
Yeah, something like that. But it's like, that's not normal, right? But I tweeted that it looks bearish and it looks like we could break below 30,000, and that's when we were trading at like kind of where we're at right now, like 31, 32,000, somewhere around here. And it looked like we were going to at least make a move for it. And then obviously we blew through 30,000. Then we bounced, and that 4-hour candle formed. This 4-hour candle formed earlier today in North America. And, I told the guys in our chat room, I'm like, look, that's a nice little false breakdown. That's going to catch some people short.
Yeah.
And now the trade, I feel, is probably exhausted. I still feel, and this goes back to my, yeah. And I'm sorry, guys, if you guys are Bitcoin people or crypto people, I really do think there's a time and place for cryptocurrencies. I don't know if they're going to be the next best thing than sliced bread. I'm not too sure about that, but I do think they're here to stay. So let me just offer that out. Yeah. I do think that the market is very saturated in Bitcoin or cryptocurrency and altcoins and whatnot. It is, since I lived through trading through the late 90s and mid 90s, I know what oversaturation of a certain market is. Look, the internet is where it is today, and Yahoo became Yahoo, and AOL became AOL, and Netflix became Netflix, and Amazon became, because of the internet. But I also could go back to 1999, 2000, and think about the thousands and thousands of companies that tried to do it and failed. And it's very reminiscent of that time. So to me, do I think cryptocurrencies are here to stay? I do. Do I think there'll probably be a few names once the dust is settled? I do. And, where does that put Bitcoin, a year from now? I don't know, but I think it's lower than where it is right now. So
sorry, go on, keep going.
I was just going to say, just with my experience, my life experience. And one of the things I have to say is markets are generational. We see it in every generation. Previous to my generation was the oil and gas industry, right? The energy markets in the 70s and 80s, and before then is the steel markets, and then you had the internet boom. Then you have now the crypto boom, and I think it takes about 25 years and a whole generation of investors to really go, well, crap, I don't remember that, or, my kids who are teenagers to look at me and say, yeah, okay, boomer, what I don't, I'm telling my kid, my kid's asking me about Ethereum. He's 14 years old and he's trading it. So through my Robinhood account. So, I mean, but I'm sitting here looking at, feeling like that old man on CNBC back in 1998. There's like, these internet stocks are going out of business. They don't even make money,
Yeah, that's right.
Kind of embarrassing. You can call me boomer. Go ahead.
No. I know you're young at heart. I put, for what it's worth, I actually genuinely, I think they're fantastic trading vehicles, not just because there's volatility and movement. I think they're fantastic speculative vehicles. I actually think we trade a little bit higher in the short term, but I think until you get that FOMO coming back in, and I think we really need to break through those 41,000 levels to start for a nice trend up, attracting that FOMO capital. I think we go a little bit higher. I think we've probably trade into 35,000, 3,500, 35,000 in the short term. But I think, in an environment where, the rate of change of the Fed's balance sheet will be declining probably from late this year and probably start in the new year. Those liquidity fueled assets will probably struggle somewhat if we get higher real yields. I think that's gonna weigh. I know we can talk about the adoption story and all those factors, but there's been a lot of the liquidity beneficiaries, and I think crypto has been one of those. So I think it's a fantastic trading opportunity, trading short, long and short. But I think we're mean reverting at the moment. I think if we get a break of that bear flag, then I think we go lower, and we're trading that from the short side.
I don't disagree with you, Chris, and I can tell you from personal experience. I remember in 1998, and I had an individual investor that I traded for, and I made him a lot of money in the late 90s. But I remember the very first big day that I had that it was a big loss. And I called him on the phone and I lost $10 on 2,000 shares of Amazon.com. Yep. And I lost 20 grand that day. And I had to call him up and say, I am devastated. And I was almost in tears and I was in my, mid 20s. But they were great trading vehicles, right? Every internet stock was a great trading vehicle back then, just like, Dogecoin or Ethereum. The only thing that's really different about now, and this is a little interesting, what I found as an American, now that doesn't necessarily mean that it's going to translate the same to you guys or wherever you guys may live, is that, as an American in the United States, we have to have a margin account, and there's only certain brokers that allow us to short, Bitcoin or Ethereum or whatever we're going to do. So we almost have to trade, unless you have a margin account, you almost have to be one-sided for most Americans. And I think most people are just, they're buy only, right? And yes, institutional guys, and when you start talking about the professionals, of course they're trading futures and they're trading different markets. But for the average Joe or average Sally investor, most of them are long only and they just buy. That's it. So
yeah. Well,
they're not trading CFDs like you guys. Which
that's one of the great things. Is, you can trade long and short, put a percentage down for if you see. That's a really interesting way to trade. I just want to go back, just hone in, because we've got one question here from Themba Murphy. If you can just scroll into that chart again, because I think this is a point that we did touch on, but it really is. I genuinely think it's one of the hardest things for a lot of new traders to understand, right? So we talked about this candle that came down, the big buying pressure that's come through. So we've got to trade through that the May low, the May swing low on the left-hand arrow that you talked about there. We traded through that level. Now, I would have thought a lot of new traders would be starting to accumulate short positions on through there. There may be some stops. You've got the trade up there. No, you've got the position up there. Just keep that up.
I'm gonna pull up a different chart because I'd rather clean it up so this way we can take a look at it.
So what you've got is you've got to move through that like what is it, that low there. We've got to move through there. You probably would get a lot of like new traders starting to short through that position. The buying support comes in very aggressively there, and obviously those people who are short on the wrong side of that, they've been cleaned out. They're obviously having to manage that position, deal with it, probably close out for a small loss. Well, that's what you'd hope would happen. What do you do on that breakout? Personally speaking, obviously I wait for, if I'm trading on daily charts, I wait for the daily close through that level just to tell me, and I'm willing to wait for for a worse price. But how do you deal with those those breaking positions? Would you initiate a short position with obviously the clear worry is that you're going to get this false breakout?
Well, first of all, I'm glad that you asked this question, because this is a good example of today. Even I was watching more people trade it because I wasn't short Bitcoin. I'm looking for more of a daily close. I'm a daily close kind of guy. And then, I'm like, okay, we close below 30,000 and we spend a good amount of time below there. And then I was like, okay, we're actually going to head lower then. But the way I treat the market now is a lot different than I treated the market a year ago. When I was prop trading, you're trading tens and multiples more than what you would be trading as an individual. So like if I'm trading 10,000 in currency or 100,000 in currency, I'm trading 1 million in currency or 2 million in currency, that type of thing. So you're trading much different multiples. So your risk tolerances are a whole lot less. And I'll tell you, my risk tolerances when I'm trading larger amounts is a lot less, because I don't like being upside down 20 grand in, an hour going, holy cow, my goodness, what happened? But when you're trading more as a retail trader and you can take smaller positions, I tend to be more of a swing type of trader where I can leg into positions now. So I can, get short a little bit. And if I'm wrong, I can cut my loss and be lost. I could lose just a little. Sorry. By the way, guys, this is like hour number 16 of me today, of being awake. So some of my words start to get jumbled up at this time of the day. So just excuse me. If I sound a little cattywampus at this time of the day because I'm a little loopy. Anyway, and I'm drinking water, just so you all know. But when I'm trading, if I'm trading, a smaller position, I can always add to it if it's profitable and I feel really confident about it moving. But if I'm like, if I was to trade Bitcoin, which I wasn't short today, but if I got short on a break below that, the first thing you got to ask yourself is, where are you going to get out? Because that's the opposite of what most retail traders think. And this is something I learned trading with a group of probably some of the most talented traders I've ever come across in my lifetime. And just so you know, most of the traders that are in that caliber, they're on social media, but you don't know they're on social media. They don't tweet about stuff. They don't talk about stuff. They are just watchers and observers. And I've met a lot of them over the years, especially in recent years.
Yeah.
But what they'll tell you and what I'm going to tell you is, you're wrong. You got to cut it. You can't stick around. And I think a lot of people as new traders or retail traders, they're always thinking about, what am I going to make? Not what do I have at risk? And it's a way of thinking when you trade. The first question you should ask yourself is, okay, I'm shorting Bitcoin below 30K because it looks bearish. And you have to imagine on this hourly candle, I can guarantee you that's what everybody was thinking right here is, oh my goodness, Bitcoin is going to, here, let me focus that a little bit. Bitcoin is going to, drop through the floor into hell. And that's probably what people were thinking. But what people were probably thinking is, oh my gosh, it's going to go to 25,000. How much money am I going to make? The first question you have to ask yourself is, where are you wrong?
Yeah.
If this thing goes up in your face, where are you going to get out? And that's where I start looking at these previous supports and saying, okay, well, I'm short at 30,000 fictitiously because I'm not, and I wasn't short. I'm just walking you through my thought process. I'm short below 30,000. It gets back above 31K. I got to cut it. I'm wrong. And I'm going to admit that I'm wrong. I'm going to get out. I'm going to take my loss. I'm going to take my lump, because if I don't take my lump there, it's going to be double worse in the future. And exactly what.
But it's the state of the market. It's the state of trading is that we're wrong, and we're wrong regularly, and it's okay to be wrong. It's a fact of life. It's how you deal with being wrong that will make you successful in the end, right? Isn't it? So you know that you're going to be wrong all the time. It's just a
Can I
question
show
of
you
dealing with it.
something? Can I show you something really unique about ForexAnalytix?
Go on.
Right now, and this is not a plug of ForexAnalytix, but I want to show you guys something.
Yeah.
These are what are called patterns in play, and you notice that right now they all happen to be from me because everybody else is kind of getting whipped around and that type of thing. If you go over to the closed patterns in play, these show you the profit and losses based on these patterns. These are technical setups that we see and we observe. But if you look at the history of ForexAnalytix, because these are all the statistics, the winning patterns in play are 52%. Think about that for a moment. And we're talking 1,017. You could go through them all. You can go through them all and go through all 56 pages of them. They're all right here.
Yeah.
Then you can go match.
And then you apply leverage onto that as well.
Yeah. But if you think about that, about 1,100 different technical setups or setups that we as experts have seen, and 50% of them are right, 52% are right. What does that tell you about what your percentage should be? Look, if you're right 50% of the time, you'll do fine as long as you understand what proper risk management is. That means where's your stop, and keep your limits pretty far out because you're going to cut them short anyway because you're human and you're going to want to take profits. And when you got a profit, you're going to cut it, even though every person on the face of the planet that's ever made money in the markets will tell you, cut your losses short, keep your winners, long. Look, I know humans. I've been watching traders for 25 years, and everybody who's profitable in a nice profitable position, they always cut part. So at least some of it to book some profits. So if you do that, keep your risk static, always have a reward that's really far out there because you will cut it short.
I think 50% is good. I mean, there's probably people out there saying, 75, 80 is what you want. But that's for me. I think the difference between sort of pro money and new retail trading money is that you end up. It's not necessarily about the win-loss ratio. It's about your risk to reward. And if you know that you can go in and ideally target 1.5, 2 times R, and you find a process where you can actually hold the positions to your profit target. If you want to trade the profit target, then you can be right. You can be right 33% of the time and still make money trading that. So for me, the actual risk reward is the most important situation. That allows me to be wrong quite often. But the hardest part is not cutting the position, a losing position. I find cutting losers quite easy to do. I look at trading as my life. If I don't like something, I get out of it and try and stop it pretty quickly. The hardest thing I find about trading is going, I want to identify my profit target around here, and actually holding on to that position, especially in FX markets, which can get quite choppy. How do I hold on to a winning position without being, feeling the emotion of taking that profit off? And of course, that's why expert advisors come in really well. And I'm really glad you brought up the dollar MEX chart, because I was going to talk to you about this one. Because if you're thinking about potentially selling rallies in the Aussie dollar against the greenback, then another way of playing that in the commodity currencies, I know MEX is more of a sort of a petro currency effectively, is by shorting the MEX. It's a high beta currency. So if the Aussie is going up 1%, you're going to get the MEX up 1.5%. So what are you seeing on dollar MEX there at the moment?
Well, this is one of those currencies that I've been following. I follow the dollar MEX carefully because somebody had asked a little bit earlier, and I'm sorry, I can't remember exactly who asked the question about volatility, near-term currency pairs. One of the more volatile currency pairs to trade, if you want volatility, is going to be an emerging market currency like the dollar MEX. Yeah. It does carry a strong or an expensive carry. If you're buying dollars, and if you're selling any emerging market currency, you're going to pay a carry cost. So just realize that it's more of these are short-term type of, setups. But I'm also keeping the structure in play because I understand that when emerging market currencies are weaker, that tends to reflect as a weaker risk environment for stocks. Now, the reason why I wanted to pull up this chart in particular is because this was my I want to say it was my chart of the day yesterday that I blogged about. And if you go to ForexAnalytix.com, just go to the blog. I post a chart there 4 days a week, Monday through Thursday. So it'd be your Friday that I post a chart. But I put up a free chart, just something that I'm kind of scouring, looking at. The dollar Mexican peso has been hot on my radar because it is a Wyckoff setup, which is an accumulation type of pattern. And what you'll notice here, and I haven't used this, so I'm not gonna try to monkey around with the drawing tools on this
Okay.
on the screen right now, but I'm gonna just use my cursor so you guys can kind of follow along here. You'll notice on the dollar Mexican peso, we formed what I was looking at as an accumulation type of base, right? And then I was looking for a low volume sell off, but a reversal. So what we did is we sold off. We matched the lows from early 2021. We didn't hit a new low, which was interesting because stocks were hitting all-time highs at that point.
Yeah.
And then we reversed, and obviously the FOMC, created this big move, this big vacuum move higher. And what that did is that actually put us in we're basically at this point right here. And this picture, you could find these on, you can just Google Wyckoff and you'll find different names for the stuff. But the jump the creek or whatever they want to call it right here, we're basically at the 200-day moving average. We're testing a breakout point, and we're testing the 38% retracement. So as long as this level holds, this should tell me that we would bounce from here naturally. This would be the next effect markup move. We should see a move like this in the dollar mex maybe over the course of the next couple of weeks. But what that also suggests is that we might actually see a reversal in stocks. Now, when I think about that, I go, well, geez, we're almost at the all-time high in the S&P. We are, but if we create a lower high, and by the way, I was looking at some of the Dow theories all flashing warnings right now. There's all sorts of people that are thinking we might be peaking here, but the fact of the matter is we're threatening a lower high, and if we make a lower high and we start making lower lows in the S&P, then my assumption will be correct. I think that the dollar Mexican peso will be trading north of 2050, probably closer to 21, and that means that the Aussie dollar is probably trading sub 75 cents, maybe closer to 74 cents in the next week or two. Yeah. So it's me formulating a plan, not just with the dollar Mexican peso, but also with the S&P and what's happening in the Aussie and what's happening. And I know that gold's really underperforming right now, and a lot of people were scratching their head today. And I know you probably have something to say about.
We're going to talk about gold in a second. I just want to quickly just jump in. We've got Diego's question. Really, really interesting because he's written dollar mex. It's very, very volatile. Now, for me, volatility is everything. It's it's right at the epicenter of markets. Dictates my position size. It dictates my direction. What assets are going to do this? I love volatility, and it's everywhere and it's all encompassing. And if you've got a currency pair like dollar mex, which has a higher realized and implied volatility than say Aussie dollar, how does that thought process play into your position sizing? And is that a major consideration for you?
It is, and I'm gonna give you a plug really quick, Chris, and he's not asking for this, by the way, guys, just so you know. One of the benefits of following somebody who like Chris Weston of Pepperstone is he gives you such important data on a daily basis from an implied volatility standpoint that'll help you gauge risk assessment. Look, when Chris and I first met, and I was using Bloomberg, he's using Bloomberg. He's got all the functions down. I'm like, oh, I'm probably using about 0.001% of all the functions I can use on Bloomberg. He knows it all. That's because that's the kind of guy that you get when you're using, you're trading through Pepperstone Securities. Is you get to look in the mind of Chris all the time, which is awesome because for me, I'm a simpleton kind of guy. I'm a very black and white, and I look at volatility and I go, yeah, we got about double the volatility in the peso than we do in the Aussie. So I take back down my position sizes about half the size that I normally would trade the Aussie. I would be trading in the peso, because I would, I try to explain to people my size between what I do on a daily basis is much different than what you do. I might have, $50,000 in my account. You might have $200,000 in your account. So my risk is going to be a little bit different than yours. And it also even could go further back. If you go through trading psychology wise, it could be, kind of your upbringing and your heritage and your like where you came from as a trader, and, family and lifestyles. Everything factors into that. So all I tell the traders that I deal with on a daily basis is find out what's comfortable for you. Like, you normally trade 10 lots. Great. You trade 10 lots. That's your comfort zone for this euro dollar. You trade the dollar MEX, you trade half of that. So instead of trading 10, you're going to trade 5.
Cool. So just on the dollar MEX, we're looking for higher moves here, and that potentially sort of coincides with lower Aussie, potentially some pullback in equity as well. We've got a couple of minutes left, so we're going to keep it brief. But Frank's written, "What's your view on gold?" So let's bring up the gold chart, because it's one of our big assets. It's certainly one of the markets that we see a lot of flow in. And I think if we were to see a lower Bitcoin price, it probably would also coincide with a lower gold price because of higher bond yields and a stronger dollar and people concerned about tapering and all these other factors. But looking at that setup now and based on the FXA ForexAnalytix models, what are you seeing right now? How would you be playing this?
Well, I'm going to tell you, I've been bearish ever since we broke the 200-day moving average below right through here. When we cracked that post FOMC last week, I threw in the towel with trying to play gold on the long side, and I think it's trading heavy. And it's interesting, Chris. I'm going to have a conversation later in 2 days with Bill Baruch, who's the CEO of Blue Line Futures. You guys might see him on CNBC, intraday type of stuff. Yeah. We were going to talk about like the Bitcoin gold relationship, and it's the millennials saying like gold is some archaic inflation hedge, where now they're like, why would I park my money in gold when I can just buy some cryptocurrency? It's that whole conversation that we're going to have from somebody who trades futures, is a futures broker, looks at open interest on gold historically, and he's come up with some pretty good findings. But the reason why I point all this out is, while the dollar has been getting destroyed, this last year, the one thing that I had expected in gold, or, the last several months rather, is I expected gold to trade a lot higher than it did. And what we did is we failed at a 618 retracement. You can see it right here. When we failed at this 1920 level, 1915, we couldn't even reach for it. I thought we'd at least get a courtesy reach around up here, hitting the 1920 level. Couldn't even do that. And as soon as we failed and started making these lower highs up here, I was like, gold's in trouble. And lo and behold, post FOMC, we slipped through this channel support. We slipped through this 200-day moving average. Now we're below the 50-day moving average, and we're going to get it's like, this is pretty ugly price action that we can't even rally when the dollar is like.
Can you scroll in?
Yeah. When today the dollar got pulverized. Well, you could say it just pulled back. Gold couldn't even get its head above water. And there's an old saying that I have in the markets, especially if you're looking at an asset and you're like, man, it should be going up. It should be going up. And yeah, if it doesn't go up, there's only one other way for it to go.
I'm personally, I think that I would wait for the market to sort of compel me here. I think if we go on to test those lows and the price rolls over here, I'll be looking at short positions, very small size, and then adding if it was to break through those levels. I like to add to winning positions rather than sort of and
I agree with you, Chris, and that's why I'm really looking at this blue line. It comes over here around the and there was no pun intended, by the way, Bill. If you happen to listen to the recording, that was totally not that intended. Anyway, but we have gold, sitting here like this, and it's consolidating, right? I mean, if you missed it below the 1845 level, you missed the first trip. Well, we have a pennant setting up. So, I think it is premature to just assume we're going to make our way lower. But when I look at chart patterns like this, it's now giving me probabilities. Like I know that we've got a more than a 50% chance of it moving lower. Does that guarantee it's going to move lower? No. But if I can look at it and say, okay, now I'm thinking there's probably a 60-40 chance it moves lower. Now it starts to influence my bias and how I'm going to attack currencies and other assets, right?
Well, I think I'm prepared. It's aggressive to be short now. It's aggressive to be long. I wait for the market to show me that the flow of capital is warming up for another leg lower, and when that is, you jump on board. So I'd wait for the pattern to complete. Wait for momentum sort of accelerate, jump on board the shorts. In my opinion, in that situation. One more really quickly. We've got very very short space of time. We've got Alan Tommy's writing about the Russell, like looking at the Russell. I don't know if you've got a chart there, Blake, of the Russell.
Yep, I sure do.
Because it's the poster child of value. If bond yields are going up, it has a big influence on the Russell. You tend to see people moving out of growth, like the Nasdaq, and into this space here. If you could scroll really quickly, you've got 20 seconds to tell me how you'd be playing this in the short term.
Well, the thing is I think it held where it needed to hold. So just going over to the daily chart, like let me remove this really quick, and let me show you what I mean by that.
Lovely pattern, yeah.
So you can see we held 50% of this range. This to me is what we call a bullish wedge. It's not really strong because what I prefer to see is something that would look a little bit more dramatic, like this, which it could still be setting up as. But what I will say is we are making consistent highs and higher lows, which is consistent with what a definition of a bullish wedge is. We held a 50% retracement with NASDAQ moving higher. S&Ps are near all-time highs or getting close to. If the overall, markets start pressing higher, you're going to get value players that look at the Russell and say, hey, I'd rather own, some of these mid-cap stocks late in the day. I just lost my voice.
You did, mate. Have a glass of water. You still there, Blake?
Yep, I'm still here. I lost my voice there. Like I said, 16 hours later, and I can see where my breaking point is.
Yeah, I think it's an interesting chart. I think if we are going to see going into this sort of window of late June into sort of September, where everyone's sort of debating liquidity conditions and what the Fed are going to do, and we've got Jackson Hole and a couple of FOMC meetings, and we do see bond yields making a rise up, the dollar starts making a rise up. You're going to see the Russell outperform, in my opinion, and I think in that environment, I think you're probably going to see long Russell, short Nasdaq work quite well as a long short pairs trade. I think that might be quite an interesting way of trading that scenario, because then we'll probably be debating infrastructure again in the US. We haven't heard anything about that for a while, and I think the domestic stocks will do quite well in that environment. But Blake, I'm going to wrap it up here. I just for everyone out there, in terms of the markets out there, what's your high conviction call at the moment, if there is one?
Oh, you had to throw this one out there.
Sorry about
high conviction call. I think the dollar was shunned so hard at the end of 2021 or at end of 2020. There wasn't one bank on the street that was a dollar bull. Not a one. And you can correct me if I'm wrong, but
you're right. You're right.
One. Oh, was that?
You're right.
Yep, zero. Right. And I would not be surprised to see the euro trade back at 117. I wouldn't be surprised to see the dollar hit new highs. And you have to hand it to the dollar. It's held up really well with risk assets as elevated as they are. And so if you get any blip lower in it, you just get a 5% correction, which is not asking a lot after what we've seen the last 16 months. You see a 5 to 10% correction in risk assets, you're going to see the dollar come out of its shoes. I think the market is very poorly positioned long dollars right now.
Yeah. Well, I think dollar CNH, the dollar yuan, is the most important currency pair that everyone needs to have on their radar. If the dollar starts rallying against the Chinese yuan, dollar CNH, the reflation trade will call into question. That dollar flow will reverberate across the rest of the pairs, and you will see Blake's call on the dollar really coming in. So if you want to look at anything, people don't really tend to look at the dollar CNH. We've seen this morning the PBOC and the state papers saying that there may be a depreciation. If we're going to see a depreciating yuan, we're going to see a strengthening dollar. That dollar will spill over in, and that could actually weigh on commodity prices. So my tidbit for today is keep dollar CNH on your radar. If that's going up, that's going to have big implications for global markets. It's going to play into a lot of what Blake's talked about, probably a higher dollar MEX, a lower Aussie dollar in the short term there as well. Blake, it's been an absolute pleasure to get some of your words of wisdom about position sizing, about how you see setups, the merger, and how the world sees the difference between, you know, the prop trading world, the institutional world, and into retail. If anyone wants to get in touch with Blake, all the links you can see on the landing page. You can see, you can go to his Twitter account. Was it Pipzar, isn't it?
Yes, and by the way, that's a given name from a client like
Yeah.
13 years ago. So that it's not, I didn't give it to myself.
Yeah. So if anyone wants to get in touch with Blake, you can get in touch with Blake on there. If anyone wants more questions around what they've seen today, obviously reach out to the team here at Pepperstone, and we'll make sure that you know, any questions have been will be answered. Thank you also to anyone who who's hang on, I was just getting one quick question. 2 seconds.
Well, while he's looking at that, I want to say thanks for having me. And those of you that tuned in, I hope you got something out of today.
Yeah, Diego, so talking about the lot size, we did cover this one earlier. We were talking about Mexican peso being more volatile in terms of the implied volatility, the realized volatility. The sort of movement you see is greater, and Blake was talking about the idea that if you're going to get that greater movement, that greater then your position, probably the risk you're going to take on will be greater. So the distance, your stop loss would probably have to be slightly further. And of course, to accommodate for that greater risk that you're taking on, you'd have a smaller position size as well. So that's how I think about the world as well. And that's what Blake was saying. So if you're going to have a high volatility asset, you will need to take more risk on in where your stop loss is, which obviously represents the risk you're taking on in the position. And the further that you're going to take that stop loss out, the smaller your position size needs to be. Obviously, if you're having a tight stop, you can have a bigger position size. They need to be the sum of the two together. So if the market is more volatile, and a great way to assess volatility on you know, the platforms that we offer is just using average true range, or you can look at Bollinger Bands. There's a whole heap of realized statistical volatility measures, but we use the 5-day average true range, or the ATR, and you can see really just if you look at dollar MEX, look at the sort of the ATR there and relative to where it's been, and that can dictate how much risk you're taking on, and then therefore your position size accommodates to that as well. So volatility is, as I say, the epicenter of markets, and it will dictate how much risk you're taking on, and how much risk you take on will determine your position sizing. If you can get a correct position sizing, you know, you're going to be halfway there to becoming creating an edge as a trader. But once again, Blake, thank you very much for joining us. If anyone's got any questions, do reach out to the team at Pepperstone. You know where to find us. And just a bit of housekeeping. We will be getting Stacey Burke on at 7 o'clock tonight, Eastern Standard Time. Stacey's a really interesting trader, got a very different technique from everything we've heard from Blake. So make sure you tune in. You can find us on the YouTube link, exactly where you found us here. So make sure you stay on for Stacey Burke at 7 p.m. I'll see you there, guys.
Thanks, Chris. Thanks, everyone.